1-minute time frame. The 1-minute chart is considered one of the most sensitive and fast-moving timeframes in trading, where price movements occur rapidly, and decisions must be made with precision, discipline, and strong emotional control. Because of its speed and volatility, it requires a clear strategy, strict risk management rules, and a deep understanding of price action, liquidity behavior, and volume dynamics. In this extended session, we will break down exactly what to look for on the chart, which candlestick formations are important, which candles should be ignored, how to read momentum shifts, how to identify liquidity grabs, and how to combine technical indicators with volume analysis to determine whether the market is moving toward buying pressure or selling pressure. To begin, we must understand that the 1-minute time frame reflects microstructure movements within the market. Each candlestick represents 60 seconds of order flow, capturing the battle between buyers and sellers during that short interval. Although it may seem small, this time frame reveals valuable insight into immediate market sentiment. Scalpers and short-term traders rely heavily on this chart because it provides multiple trading opportunities throughout the session. However, it also produces noise, false breakouts, and emotional traps. Therefore, we must filter signals carefully instead of reacting impulsively to every candle that appears. Each candlestick consists of 4 essential components: open, high, low, and close. The relationship between these 4 prices tells us who controlled the market during that minute. A strong bullish candle with a large body and minimal lower wick indicates aggressive buying pressure, especially if it closes near its high. This shows that buyers maintained control throughout the minute. On the other hand, a strong bearish candle closing near its low suggests dominance by sellers, but candle size alone is not enough. We must compare each candle with previous candles to understand context. For example, a bullish candle appearing after a strong downtrend may represent a temporary pullback rather than a full reversal. Context always matters more than a single candle pattern. Now let us discuss which candles deserve attention and which ones should be ignored. High momentum candles that break previous highs or lows with strong volume are significant because they show institutional participation or strong retail interest. Breakout candles with expansion in range and volume often signal continuation. However, small candles with long wicks on both sides usually indicate indecision. These are often formed during consolidation phases where the market is collecting liquidity before making the next move. Trading inside consolidation without confirmation increases the probability of being trapped. Therefore, we focus on structure breaks, momentum shifts, and volume confirmation rather than random candle formations. Volume analysis is one of the most powerful tools when trading btcusdt on the 1-minute chart. Volume reflects the number of transactions occurring during a candle. When price increases with increasing volume, it shows genuine buying interest. When price rises but volume decreases, it may signal exhaustion or a weak push. Similarly, when price drops sharply with rising volume, it indicates strong selling pressure. Volume spikes near key support or resistance levels can reveal either a breakout or a rejection. For example, if price approaches resistance with increasing volume and closes above it, the breakout is more reliable. If price touches resistance with high volume but closes below it, it may indicate rejection and a potential reversal. Another important concept is market structure. On the 1-minute time frame, structure changes rapidly. Higher highs and higher lows indicate a bullish trend, while lower highs and lower lows indicate a bearish trend. Before entering any trade, we must identify the current structure. Entering long positions during a bearish structure increases risk unless there is a confirmed reversal. Structure break combined with strong volume is often a powerful signal. For example, if the market has been forming lower highs and suddenly breaks the previous lower high with strong bullish volume, This could signal a shift in short-term momentum. Technical indicators can support our analysis, but they should never replace price action. Moving averages help identify trend direction and dynamic support or resistance. When price stays above a short-term moving average and respects it during pullbacks, the trend is considered strong. RSI helps identify overbought and oversold conditions, but on the 1-minute time frame, it should be used carefully because markets can remain overbought or oversold during strong trends. Volume indicators such as volume moving average or VWAP can provide additional confirmation regarding institutional interest. The key principle is confluence. When multiple tools align with price action, the probability of success increases. Liquidity is another critical concept. Markets often move toward areas where stop-loss orders are placed. This creates liquidity grabs or stop hunts. On the 1-minute btcusdt chart, you may notice sudden spikes above previous highs followed by immediate reversals. This often indicates that the market collected liquidity before moving in the opposite direction. Understanding this behavior prevents traders from entering late or placing stops too close to obvious levels. Timing also plays a vital role. Volatility increases during major trading sessions or when significant economic news is released. During high volatility, movements become cleaner and stronger. During low-volume hours, price may move sideways, creating choppy conditions. Recognizing these periods improves trade selection and reduces unnecessary risk exposure. Risk management remains the foundation of success. On the 1-minute chart, even a small mistake can quickly turn into a loss because price moves fast. Stop-loss placement should be based on structure, not emotion. Position sizing must remain consistent. Traders should avoid revenge trading after a loss and maintain psychological discipline. Consistency is more important than high-risk gains. Psychology is often overlooked but extremely important. Fear and greed can distort judgment. Many traders exit winning trades too early due to fear or hold losing trades too long due to hope. A structured plan eliminates emotional decision-making. Before entering a trade, define entry, stop-loss, and target. If conditions change, reassess logically instead of reacting emotionally. In conclusion, analyzing btcusdt on the 1-minute time frame requires a balanced approach combining price action, volume analysis, technical indicators, market structure, liquidity awareness, timing, and risk management. The goal is not to predict every movement, but to identify high-probability setups supported by strong confirmation. By focusing on candle behavior, volume strength, structural breaks, and indicator alignment, we can determine whether the market sentiment is shifting toward buying pressure or selling pressure. With discipline, patience, and continuous practice, traders can develop the skill to navigate the fast-moving 1-minute btcusdt. First, we begin by understanding the structure of the 1-minute chart. Each candlestick represents 1 minute of price activity, showing the open, high, low, and close within that short time interval. Even though the time frame is small, the information contained within each candle is extremely valuable. Large bullish candles with strong bodies and small wicks often indicate aggressive buying pressure, especially when supported by high trading.